We're going to look at cash and the internal controls for cash. When we're talking about internal controls, we're talking about controls or rules put in place to help control or protect a particular asset. So in this case, we're looking at how do we protect our cash or our cash equivalents. All companies that are publicly traded are now required to have an internal control system, and that's because of the Sarbanes-Oxley Act, and we'll look at those kind of specifications in a couple slides. But even before the Sarbanes-Oxley Act, most companies had some sort of internal control system, and this is the way that they protect their company. So internal controls can be put in place to protect specific assets, or they can be put in place to protect specific transactions and things with the company. So we're going to right now concentrate on cash and cash equivalents. So you can see here, in this case, we're protecting our assets with our internal control for cash, and in this case, we're protecting the cash asset. Internal controls can also be used to help ensure reliable accounting. So you might have different controls or procedures in place about who can make particular journal entries or which people can actually input journal entries into your system. There's other internal controls about who can make specific purchase orders, or a control about this person can make a purchase order, but then it needs to be reviewed by someone else. So it's a system of checks and balances. There's also internal controls in order to make sure people comply with company policies. So an example might be an internal control that requires everyone every year that they have to read the company's statement on ethics, and they have to, take some kind of survey to say that they have read that. That's an example, making sure that we're following specific policies. Or we can have controls for efficient operations, meaning that there are controls in place that we as a company have studied the best way for things to move, and we put controls in place to make sure that things are working the way that we want them to do. Now, an internal control system is put in place to help promote all of these different things. However, an internal control system does not mean that 100% of the time it's going to work. And we'll talk about what could cause internal control systems to fail in just a minute. So I mentioned the Sarbanes-Oxley Act, and this is just an act of Congress that was put into place after there were a series of accounting-type scandals. If you remember anything from the early 2000s, for example, companies like Enron and WorldCom, they had huge financial accounting frauds, and because of those frauds, everyone at the companies lost their jobs. Their auditor, at that time there were 5 big auditing firms, there are now 4, but because their auditor missed or kind of overlooked some of the things that they were doing, their auditor no longer exists because no one else would hire that auditor, so they went out of business. People lost all their investments in these companies, and also the employees who lost their jobs, not only did they lose their income, but they also, many of them had pensions and 401ks wrapped up in those companies, and so the value in those was lost along with the stock value of those companies. So because of these scandals, Congress decided to step in and to help ensure that things like this would not continue happening. Now again, anytime you're talking about fraud, people can always get around the rules. There are always loopholes. So for every new act or every new rule that is made, people who want to do wrong will continue looking for the way to get around those rules. So again, the same way that internal controls are not perfect, the Sarbanes-Oxley is also not perfect. So the Sarbanes-Oxley Act had many different provisions, and right now we're just going to talk about the provisions regarding internal controls. So the Sarbanes-Oxley Act, or you'll commonly hear it called SOX, requires managers and auditors of public companies to document and certify their system of internal controls. So they're saying not only are you required to have a system of internal controls, but you need to document each and every control, and you need to certify that you understand what's going on with the system. Not only that, one specific section, Section 404 of SOX, requires that management, first they document their controls, and then they need to test these controls. So they'll go and sample and make sure that the sample of controls that they test are working correctly, and so therefore they're assessing the effectiveness of their internal controls. So what this is saying is, first you need to have internal controls in place, and then you need to be going and auditing or assessing those internal controls yourself. On top of that, managers have to create a report or a review saying how effective their internal controls are. And then when these public companies are then audited, it used to be that your auditors just came in and they audited your financial statements. So now your external auditor comes in and they audit your financial statements, but they also do a review to say whether or not they agree with how management has assessed the effectiveness of their internal controls. So the bottom line is you have to have controls. Management has to test those controls, and then their auditor also has to review and say whether or not they agree with management's assessment of their internal controls. So internal controls have gotten a lot of interest lately, mostly because of SOX and the fact that if internal controls are working correctly, if an internal control system is well designed, it should help to prevent fraud. So we'll just talk about some basic internal controls or some basic internal control principles that you'll see at all kinds of companies. So internal controls help to establish responsibilities. And what this is saying is we establish who is allowed to do certain things. And so now that we have computer systems, it's very easy to establish responsibilities. You can give this username responsibility to make journal entries. Or this username is responsible for approving certain journal entries. Another thing would be saying who or what users for your computer system are allowed to make purchase orders, and you would have required approvals built into your system. Another internal control principle is that internal controls will help us to maintain adequate records. We'll ensure assets and bond our key employees. We can separate record keeping from the custody of assets, and we'll talk about this as we move forward. But what this typically is called, it's a separation of duty. So if you have record keeping and custody of asset, you want to separate these responsibilities. And that's because whoever has custody of assets, so whoever has their hands on the cash accounts, those are the people who could actually steal the cash. So if they also have access to the records for the cash, they could steal the cash and then they could cover up their theft by adjusting the records. So instead, if we keep these different responsibilities separated, you can steal cash, but you cannot easily change the records because someone else would have to change the records for you. So this is a basic principle of internal control. And as I mentioned, internal controls are not perfect. And the biggest threat to internal control is called collusion. And collusion is where people work together to circumvent internal controls. So this is an area where collusion could be very dangerous. So you could have some people who decide to work together. One person has custody of assets, so they steal cash. And then the other person working along with this person, they adjust the records for the amount of cash that has been stolen. And then the two of those people split the stolen cash. So we'll talk a little bit as we go on and in different sections about collusion. But collusion is a way to circumvent our internal control, and in particular it circumvents the separation of responsibilities or separation of duties. Moving forward, we'll divide responsibility for related transactions. We'll make use of technology to help apply technological controls, and we'll perform regular and independent reviews. So what this means is not only is management assessing internal control, but we also have independent reviews. So this would be like our auditors, our external auditors, who also assess internal control. And we want to do that regularly. So, we'll test our internal controls throughout the year, and then we'll have our auditor assess our internal controls at least once a year. So when we talk about technology and internal control, technology helps to implement internal control. It makes internal controls more easy and more efficient. Some examples would be we have reduced errors, because anytime you're using technology versus having a human key in everything, you're going to see a reduction in processing errors. You're also going to see limited evidence of processing because there's less paperwork. You have increased in e-commerce. We can implement that separation of duty that I talked about because you can say who is or is not allowed to do specific things. And then also because of technology, we can more efficiently test our records because we can have a computer to do some of the testing for us as long as we define our parameters. So I talked about some limitations on internal control, and we have two basic limitations. We have error versus fraud. Error is a simple mistake. And because people make mistakes, sometimes they don't follow through with internal control procedures. People can make mistakes because they're simply not paying attention, they're negligent, they're tired, they didn't have good judgment, or they're confused about internal controls. And that's why it's important for management to constantly assess the effectiveness of their internal controls. Because, for example, if someone is confused about what an internal control is, they may not properly follow it. On the other hand, we have fraud. And fraud is defined as the intent to defeat internal controls for personal gain. And that's where we talk about collusion or someone purposely circumventing an internal control for some type of personal gain. So we mentioned before the fraud triangle. And so when we're talking about internal control, someone can commit fraud if there's opportunity, pressure, and rationalization. So when it comes to internal control, opportunity is what we're looking at when we're talking about the fraud triangle. Because if we have sufficient internal controls in place, we're hoping to limit the opportunity because our internal controls should limit the chance that someone has to commit fraud. So we've talked about the cost versus benefits. So even though internal controls are important, we want to make sure that the cost of our various internal controls does not exceed their benefits. So let's talk about this. Let's say we have a specific account, it's a small petty cash account, and we only keep, let's say, $100 in there. It would be a waste of our time to have numerous internal controls for that petty cash account. Because anytime we're doing anything in the business world, and we have an employee doing any type of job, whether it's internal control or some type of processing or whatever it is they do, that person costs money. So if we have 10 or 15 random internal controls for this small petty cash account, the cost of controlling that petty cash account could outweigh its benefits because all we have to lose is $100 with that petty cash account. So while we may have one fairly simple internal control on that small account, we want to make sure that we don't have too many because in that case the costs would exceed the benefit that we were getting from those internal controls. So now let's go in and we'll define a little bit more what we mean when we talk about cash and cash equivalents. And we're also going to talk about a term called liquidity. When we talk about liquidity, we're talking about how close is an asset to cash. So in terms of liquidity, the most liquid asset is cash because you cannot get any closer to being cash than if you have cash. The next most liquid type asset would be a cash equivalent. A cash equivalent is an example of maybe an investment in stocks, or if you had a certificate of deposit at the bank. Those are examples of cash equivalents. And those are considered very liquid because all you have to do is basically go to the bank and get your money out of whatever the investment is, and there you have cash. If we keep going on down the road as to what is liquid or not, the next liquid asset, a good example would be your accounts receivable. Accounts receivable are a promise for what? For cash. So that is very close to cash. So when we talk about liquidity, that's what we're talking about. How close is something to cash? So when we're talking about controlling our cash, we want to have a system of internal control that protects our cash and our cash equivalents. and we have some basic guidelines. So we want to handle cash, and we want the person handling cash to be separate from the person that keeps the records for cash. And this is what I was talking about a separation of duty. So whoever has control of the asset does not have control of the record keeping for that asset. The next basic guideline is that cash disbursements are made by check. The reason that it's useful to make disbursements by check is because when you use a check, there's a paper trail. So it's easier to track where your cash is being used rather than if you're simply paying with actual cash. And then finally, we want to make sure that cash receipts are promptly deposited in the bank. So this is where, if you have a company that has a cash register, typically you'll have employees who maybe go to the bank to deposit cash at lunch. And then someone will go and make a second deposit at the end of the day. There are different rules and guidelines that specific companies will use, but the bottom line is you don't want to have cash or large sums of cash sitting around waiting to be deposited, because when that money is sitting around, that's when it's most likely to be lost or stolen. So we want to limit the time between when we receive money and when it goes to the bank. We've already discussed cash and cash equivalents and liquidity, but the basic idea is that cash is currency, coins, or anything on deposit in the bank. Cash equivalents are short-term, highly liquid investments. So these are investments that are quickly convertible to cash, and they have a close maturity date, and it's not sensitive to interest rate changes. So those are specific definitions of cash and cash equivalents. Whenever we're managing our cash, we have two basic goals in mind. First, we want to make sure that we have enough cash on hand to make our cash payments when they are due. That's just absolutely essential to a company, because if you don't have cash on hand to make payments, you can make your suppliers angry, you can fail to meet important deadlines, and this can cause big problems for a company. Also, you want to make sure that you keep a minimum level of cash necessary. So although we want to make sure we have plenty of cash on hand to make our payments, we don't want to have a huge balance of cash sitting around. Because if we just have a lot of cash sitting around, whether it's sitting around in a register or in a bank, that cash is not being used efficiently. You don't want to have a whole lot of cash on hand, because if cash is just sitting, you're not earning interest, or you're not able to go and make investments with that cash. So we want to make sure that we are collecting our receivables quickly, meaning that when we have sold something or we have earned some type of revenue, and someone has been given the ability to pay us in the future, we have an account receivable. And we want to make sure that we are effectively collecting those receivables. We're not letting them sit for long periods of time. So we're following up with people if they haven't paid us on time, and we're actually actively collecting on those. We only want to keep necessary levels of assets, and that's what I was saying. You want to keep the minimum amount that you need. Because remember, anytime we have assets, those are being funded through liabilities or equity. So there's always a cost to our assets. So we don't want to have assets on hand that we're not using efficiently. We want to plan our expenditures. So you want to be aware of when payments are coming due so that you can properly plan on having the cash on hand to make those payments. And if we have excess cash, we want to make sure that we're properly investing it so that we can be earning some type of return on that cash rather than having it just sit around in a checking account. So let's talk about some of the controls we can have on cash receipts. So here we have a basic picture of what's going on, and this is when we are bringing money into our company from our various customers, whoever owes us money. So you have a picture here. Most money is brought in through the sales department. An example of the sales department would be simply a clerk who rings up sales on a register. So they're collecting money, and as they're ringing up a sale, a record is being created. Now, even though this person has access to the cash through the register, they are not the person who has responsibility over the records for this cash. although the register is creating the record, they are not creating the information that goes through the register. The computer is automatically doing this, and the information is being sent to a supervisor. The supervisor then is going to read the register data, which is automatically created through the computer system, and they'll prepare a register sheet. So this is basically where we begin to make a record of what's going on. So then we have a cashier. You will have your clerk who sends their money and their register sheet to the cashier. The cashier will also get register data from the supervisor. The clerk will reconcile the data between, the cashier will reconcile the data between the clerk and the supervisor, make sure it agrees, and then the cashier is the person who prepares the cash records, and they make a deposit slip and the appropriate journal entry. So anytime we're dealing with humans, you can always have errors. You can also have fraud. So anytime we're talking about errors or fraud, we may end up having cash that is more than what we should have, or it could be less. And we deal with this by making a journal entry to cash over and short. So if you think about a basic clerk at a register, or if you've ever worked with cash, it's very easy to come up $1 or $2 short for the day when you're making all kinds of payments and transactions. So the way we deal with this is making a journal entry for the difference. In this case, our register shows records that we should have $550, but then when we actually count our cash, we see that we have $555. So we are actually over in our cash. We do this by showing a journal entry to cash over and short for a credit, because this is additional cash that we have brought in. Now, it's important to note that we are not going to lump this in with our sales, because this extra $5 is not an extra $5 in sales revenue. It's due to a mistake. So we want to make sure that we keep this in an account that shows what it's for. Do not make the mistake of lumping it in with our sales, because our sales are correct at $550. If we ended up with short cash, meaning we had less cash than we should, then we would show that as a debit. And this debit works similar to an expense. It just shows the fact that we had less money that we should have had. So in this case, the register shows us we should have $625, but when we count, we see we only have $621. So in this case, we have cash over and short of $4. Again, make sure we're not doing anything to sales, because sales are $625. So we never want to adjust that sales amount for cash over and short. So then another way that we can bring in money is if we get cash receipts by mail. Preferably, you would have 2 people assigned to the task of opening mail, because again, with the idea of separation of duties and having checks and balances, if you have 2 people assigned to the job, they help keep each other in check, they're working together, and you're less likely to have issues with people stealing, unless, of course, they decide to collude together, so if you have an issue with collusion. You have a separate cashier who deposits the money in the bank, so the same person that opens the money is not the person that actually makes the deposit. And then you also have a record keeper, and this is the person that makes and keeps the records for the cash that is brought in through the mail. So again, we're going to keep all those different responsibilities separately. So then what about when we pay cash? What kind of internal controls can we have over our cash disbursements? This is very important because oftentimes cash can be stolen very easily when people make fictitious payments or they pay fictitious invoices. So the example here is they could create an incorrect invoice and then they have their own P.O. box account, and so they say that the invoice is payable to this particular P.O. box. So then when the company makes that payment, it goes to their P.O. box, and then that specific employee can then collect the money. So we want to make sure that we're watching our cash disbursements. We'll require that all expenditures are made by check because, again, then there is a trail or a record to follow. and you're going to limit your access to your checks. So only the people who have the authority to sign and make checks are the people that actually have access to those checks. Not only that, any time that you're making payments, you want to have a specific control over your voucher or your payment system. So you want to have different people in charge of your various responsibilities. So you want to make sure you have people that verify, approve, and record your cash disbursements. And then again, you want a separate person to actually be issuing and writing out those checks. And you want to make sure that payments have always been verified or approved by someone who understands what the invoice is for. Because if it's a fictitious invoice or a fake invoice, someone's not going to be able to verify why that payment should be made unless someone's not paying attention. Oftentimes with voucher systems, you have the problem that is termed rubber stamping. Meaning if you think about someone who is sitting and they have to approve a number of vouchers, and if they have a rubber stamp that says approved, if someone is rubber stamping, they're not paying attention to what they're approving. They're simply trying to get through the job quickly, and they're basically putting their approval stamp on everything before they actually look at it. If an internal control system is working properly, whoever is in charge of approval is actually getting an understanding of what they're approving before they actually use that rubber stamp to show that it's approved. So again, even if you have control systems in place, you can have things that fail. Now, if someone is rubber stamping or approving things without looking, they might be acting negligent, but that's not necessarily fraud. If they are doing it intentionally for their own benefit, there could be fraud. But if someone's simply just being lazy and not paying attention, that's human error as opposed to fraud. But again, it's interesting to understand the way these happen. So here we just have a basic example of a voucher system. We're not going to go through all of this, but it's just a basic understanding of the way things work. So we're going to look more at the control of cash disbursements. So we mentioned the petty cash fund when I was talking about immateriality and the cost benefit. So to make things easier, we can have a petty cash fund. And a petty cash fund is a simple way to have a small amount of cash that's easy to use. So examples of payments that might be made out of the petty cash system might be payment for postage or courier fees, small repairs or supplies. Another example would be if, for example, you're bringing in lunch or coffee for someone at your company. You could use the petty cash system. The reason we have a petty cash system is because these payments are small. It would be silly to go out and go through an entire check procedures to have someone approve a check and make a purchase order for a check for, $10 or $5 of postage. Instead, we keep a small amount of cash on hand in order to make these small immaterial payments. But we still do have some basic, very simple controls around the petty cash fund. So first we have to establish the petty cash fund, and we do that by simply setting aside cash into our petty cash fund. So you can see here's our basic journal entry to establish petty cash. We first need to show a decrease in our general cash account, and now we're going to set it aside into a separate asset account that we call petty cash. This is just an asset transfer from one cash account to another. Then, as we're using petty cash, we need to make a record of that. So we would keep all of our receipts to keep track of how much petty cash has been used. And you can see here are some examples. We had some miscellaneous expenses, cleaning of some panels, some basic tile cleaning. We had transportation of some merchandise, so just some little transportation fees. We had a delivery expense, and then some office supplies expense. So this is showing how our petty cash was used. In the end, we have now used $71.30. So to show that, we need to show all of our various expenses. We had miscellaneous expenses. We increased the value of our merchandise inventory because we paid some shipping on our inventory, and therefore that increases the value of the inventory. We had some delivery expenses and some office supplies expenses. So all of those expenses are shown for the proper amount. And then we need to show that we used up some of our cash. So you can see here we're showing this credit to cash for $71.30. As we move forward, we can also get an understanding of what goes on with our bank and how we can use our various basic bank services to help us with our internal controls. So whenever you're working with a bank for a company, you'll typically have signature cards. And these are cards on file with the signature of the various people at a company who are allowed to sign for various payments or transfers with those bank services. We have various bank accounts that have our money in them. Banks provide us with checks, and checks, as we've said, are very important to helping us keep our records. It's also important to note that checks, if you've never noticed before, even your personal checks are all numbered and they're in numerical order. It's important to keep track of that because if a check gets stolen, if you're keeping track and making sure that your checks are used in order, you'll notice if all of a sudden a check is used out of order because someone stole a various check. So just something interesting with checks. We can have electronic funds transfer. Again, an EFT is better than just simply paying with cash on hand because EFTs have a record both at the bank and in your bank statement. We have bank statements, and we use bank statements. They're very important for a major cash control that we'll look at in a minute called a bank reconciliation. A bank reconciliation is basically where we're comparing what is on our books versus what the bank says that we should have, and we'll look at that when we move forward. And then we also have deposit tickets. These are independent verification of cash that is being deposited into our bank. So here we just have a basic example of a bank statement. So this is the bank's independent information saying what cash you have on hand. So you can see here this would be your previous balance, so the balance at the previous month. We show the total checks and debits, so this is the money coming in, and then we show our deposits and credits, and all of that makes up our current balance. Our bank statement should agree with what our books say that we should have. However, there are certain timing differences, and we'll look at those that go on, that will create a difference in our bank balance and the balance that our books say we should have on our cash. And we'll talk about those when we look at the actual bank reconciliation. So as I mentioned, the bank reconciliation is one of the best controls over cash, because what we're going to be doing is comparing what our books, so all of our various journal entries and transactions that we have kept a record of at our company, will tell us what we have on our books as our balance and our cash. We can then compare our book balance to the balance that our bank says that we have in our cash. And if there is a difference, we would look and see what causes those differences. So a bank reconciliation is prepared periodically. Typically you do it every month, and this is someone's job. And the difference between the cash reported on the bank statement and the cash balance on the company's books needs to be reconciled. When you complete a bank reconciliation, you typically have two sides to that reconciliation. First you have a bank side, and then you have a book side. What you'll do is you'll take your bank balance and put it at the beginning of the bank side. Then you have a book balance. We'll make our various adjustments, and then at the end we should have an adjusted bank balance and adjusted book balance, and these should be in agreement. So the first question is, why would your books and your bank statement have a different amount? And these are mostly due to simply who has what information at what time. And there can be specific errors on the bank side or on the side of the company, so on the book side. And you have to make adjustments for those. So let's talk about the timing differences or the items that could cause a difference between the book and the bank side. So first we can have what we call a deposit in transit. And this is on the side for the bank. So on your bank reconciliation, we have the bank side and the book side. So a deposit in transit. This is a deposit that a company has made that has not been reflected at the bank yet. So if you think about a company who comes and makes a nightly drop of cash at the bank, that cash is typically not going to be showing up in your bank statement until sometime the next day, whenever the bank counts that cash and credits your account for it. So a deposit in transit. The bank already knows that, the company already knows that they have made this deposit. So this deposit is already reflected in the cash balance on the books. However, until the bank actually goes and gets that deposit out of their night drop, they don't know that that's there. So that's one reason you could have a difference between the cash balance in the books and the cash balance of the bank. Another example is an outstanding check. An outstanding check is a check that a company has written, but it has not yet been cashed by whoever they wrote the check to. So think about this. If you're a company and you write a check, as soon as you write that check, you reduce your cash balance for the amount of that check. So the cash balance per the books is going to show a deduction in the cash balance at the moment that they write a check. On the other hand, when does the bank find out about that check? They do not find out about that check until the check is actually cashed. So sometimes, and it happens fairly often, you might have a person or a company who doesn't immediately cash a check. Maybe they wait a month or two. This is an outstanding check, and it can cause a difference between the cash balance in the books and in the bank, because the books have already shown a reduction for that amount, whereas the bank won't know about it until it's actually cashed. And then if the bank has made any errors, that could cause a difference, and those could be positive or negative for the bank side. Then let's talk about the balance on the books. So there's specific information that your bank may know before you as a company know. So what that means is that the bank has already reflected these things in their bank statement, but you don't know about them until you're told that by your bank. So examples could be collections and interest. So if your bank collects money from your specific customers on your behalf, you may not know that that collection has been paid until you get your bank statement. So the bank statement is going to show that the collection was made, but your books won't show that collection yet. Also, if you receive interest, if you have a checking or a savings account with the bank is the one who actually calculates and gives you the interest. So you as a company don't know the exact amount of the interest until you get your bank statement. So the bank statement shows the exact amount of the interest, whereas your books, you don't know what the exact amount of interest is, so your books don't show that yet. Then if we have uncollectible items, so this is, for example, if someone writes you a check and you deposit that check, you have increased your cash balance for that check. But what happens if the bank goes to cash that check and then the person actually doesn't have enough funds in their account to do that? The bank immediately knows that they are not going to credit your account for that money. You, on the other hand, don't know that that was non-sufficient funds until the bank tells you, so uncollectible items are included. Then let's talk about errors. Again, anytime you're working with humans, whether it's the banks or at your own company, you can make errors. So if the company or your company's bookkeeper is the person that has made an error, you'll need to make an adjustment for that error on the book side. We'll go through an example that actually shows us how to do this, but in the end, we should have the same balance from our adjusted cash balance from the books and on the bank side. Now, I also want to note one more thing. Once we make a bank reconciliation, we need to make journal entries. We only make journal entries for the items on the books side, because all these items that are being adjusted for on the bank side, they are things that the company already knew about, so they've already made journal entries for these items. It's only the things like the collections and the interest and the new information about what's uncollectible that you didn't know about as a company, and therefore once you have determined that these are reconciling items, you'll need to make journal entries to reflect those payments coming in or out. So it'll get your books up to date. So here we just have a basic example. So we have our bank statement balance. So this is where we're going to begin. And we had $2,050 per the bank statement. To that, we need to add any deposits in transit, because this is money that the bank does not know about, even though it's money you have deposited, and it will soon be reflected in the bank statement. At the time the bank statement was created, they had not yet counted this money. So we'll need to show an increase for the amount of any deposits in transit. In this case, it was $145. Then we need to look to see if there are any outstanding checks, because an outstanding check is a check we have already written, but the bank doesn't know about it, so that amount is not reflected in their balance. In this case, we had 2 outstanding checks for a total of $350. So our adjusted bank balance is $1,845. Had the bank made any errors, we would need to make those adjustments on the bank side of the bank statement. So now let's look at the book side. Per our company records, we have a book balance of cash of $1,404 and some change. We need to add to that any collections that the bank made on our behalf. Because if they made collections on our behalf, we don't know about those because we were not in control of them. We will know about those by looking at the actual bank statement. So you can see here they collected $500, but to do so they charged us a $15 fee. So we would need to add in that we have $485 being added to our balance. We also earned $8.42 of interest. Then we'll need to make deductions for any kind of charges that we now have. We had a check printing charge, so this is a charge that the bank made for $23, so we now need to reduce our balance by that $23. And then we had a non-sufficient fund check plus the fee related to it. So what that says is maybe someone wrote us a check. The check was bad, meaning they didn't have enough money in their account. So not only do we need to reduce our book balance for the amount of the check, but we also have a service fee for processing that NSF check. So now we have adjusted book balance of $1,845. If we have done our reconciliation correctly, you can see here that we balance. Now, what happens if you still don't balance? You would then go back and look at your records, try to find out if someone made an error. Or if you still simply cannot balance, this might be an indication that there's fraud going on. So that's something very interesting to look into. A way fraud might be going on is if someone's stealing money and they're not providing any kind of record. So that theft is not going to be reflected in your books, but it is going to be reflected in the bank statement, because if someone has stolen money, less money is going to be in the bank. So typically, if there is some type of theft or fraud, the bank statement is going to end up being lower than the books, even after the reconciliation. So as I mentioned, anytime you have a bank reconciliation, if you have reconciling items on the book side of the reconciliation, you'll need to make journal entries for those reconciling items, and those journal entries will get your books up to date. Again, you only do them for the book side of the reconciliation. So you can see here, first we need to make a journal entry to record the collection fee and the proceeds for the $500 that the bank collected on our behalf. So we'll show we have cash coming in of $485. We had a collection expense, this is the fee for $15, and then we'll reduce our notes receivable by the entire amount of $500. We then need to show the interest revenue we have earned, so cash is being debited, interest revenue is being credited to show that earning of interest. We then had some miscellaneous expense, and that was for the check printing charge for $23. So we debit that expense and show the payment in cash of $23. And then we need to deal with this non-sufficient fund check. So when someone gave us this check and we went to deposit in the bank, we thought that first we got cash, and because we got cash, we need to reduce the account receivable. So now that we see that this cash was a bad, or this check was a bad check, we need to reverse that entry. So we need to show that when we got the check, we had reduced this person's account receivable. But the truth is their check was bad, so they still owe us that money. So we need to put the account receivable back in place, saying that someone owes us money. And then we need to reduce the cash, because remember, when we deposited this check, we would have increased our cash balance. There was no cash in this person's account to back up the check, so the bank did not put the cash in our account, so we need to reduce the cash balance. The original check was for $20, but the bank also charged us a $10 fee, so now that person owes us $20 plus $10, the full amount of the check that they originally owed us plus the fee that we were charged. And then we need to reduce our cash balance for the full amount, because we had originally increased our cash for $10, and then the bank also charged us we had originally increased our cash balance by $20 when we deposited the check, so we need to take that full $20 off of our checking balance. And the bank charged us $10 of our cash, so we need to show that here, and that's reflected by summing together the $20 plus the fee. Finally, we're going to look at a ratio related to the collecting of our accounts receivable, and this is the days sales uncollected. This is simply going to tell us when we do accept an account receivable, meaning someone makes a payment or someone buys something and they're going to pay us in the future, we have an account receivable. How many days does it take us to collect on that account receivable? Remember, one of our basic principles with cash is we want to get cash in as quickly as possible. So the lower this ratio is, that means the more effective we are in collecting our accounts receivable. This is fairly simple to calculate. We take our accounts receivable, divide that by our net sales. This is going to give us our accounts receivable turnover. Then we'll multiply that by 365 days, and that is going to tell us on average how many days it takes us to collect on our accounts receivable. You can see here the days sales uncollected for two different companies, Hasbro and Mattel. These are both toy type companies, so they're in the same industry. So typically you would imagine to find that industries usually have similar ratios, and we can look and compare these ratios to see who is doing something better than the other. You can see here, let's just look for 2013, for example. Hasbro is taking about 98 days, whereas Mattel is a lot shorter at 71 days. What this tells us is that Mattel is more effectively or more efficiently collecting on their accounts receivable, because again, the lower days sales uncollected, that means the more quickly you are accepting or you are bringing in your accounts receivable.